Mihir Vora joining us, CIO at Trust Mutual Fund, to talk more about markets. But Mihir, first, just a question or two on everything that's playing out with regard to the retail investors' safety is concerned. Now, you do have SEBI, which is taking appropriate steps, but you know, some or the other case slips the cracks. What's your take with regard to this problem that we've been facing? This is not new. It's been happening since decades. But you have that that experience to tell us how should one respond to this?
Hi, good afternoon.
Good afternoon.
There are two or three, guidelines or truths in the market, when anybody is, trying to make a quick buck. One is that there is no free lunch, right? And second is it's always caveat emptor, buyer beware. It is always the responsibility of the buyer or the customer to do his due diligence whenever you are embarking on any investment or any endeavor or strategy, so to say. So I think you can't just wish away the fact that there will always be fly-by-night operators in the market. While the regulators can do, and I'm sure they are doing, the exchanges, I'm sure they are doing whatever they can, but ultimately, it's your money and it's your responsibility to protect your money with the appropriate due diligence while embarking on these kind of initiatives, so to say. So I think there is enough information available in the in the world these days. You have the internet, you have common sense, you have everything available. You have company financials. So you can't say that you did not know. If you kind of still fall prey to such things, it's only because you did not adequately take your money seriously and you did not do your due diligence. So I think please do your research before you embark on any of these things.
So, Mr. Vora, point taken. Clearly, one has to be careful. Let me take a step back. Let's talk markets, sir, because I have this opportunity. So, we've seen a longish period of consolidation now, and 2 weeks is long, especially in the trading world. We've seen a bit of a consolidation. Just if you can help us, give us perspective on this. Take a step back. Let's look at where valuations are at. Certainly not cheap. Globally, too, there is some bit of uncertainty. Domestically, consumption isn't picking up. How do you view valuations at this point, given all of this that's playing out?
Sure, absolutely. So I think what you said is that we are in a kind of a wait and watch mode as far as the markets are concerned. If I look at the overall backdrop, liquidity is not going to be a problem. So domestically, there is enough fund flow to the market. Globally also, given the fact that you will have willy-nilly fiscal deficits running high in the US, you want the central banks, and the central banks, most of them are going the rate cut way. So there is going to be ample liquidity. The dollar's strength is no longer a given. So the anti-dollar trade, so to say, in commodities, in gold and silver that we are seeing, and flows to emerging market, I think that trend will continue this year. So I don't think liquidity is going to be a problem for the Indian markets. That will continue. But what we will need is fundamentals and results to back that liquidity, and that's what I think the markets are waiting for. The results season has just started. You had a mixed bag of results so far, and as the results season progresses, I think the markets will start forming its view. My guess is that given the state of the market, given that we are not very cheap in terms of valuations, we are not extremely overvalued also. So we're kind of in the middle neutral zone, kind of so to say. My guess is that it's going to be a stock pickers market. It's going to be a very sector and subsector specific kind of a market.
Where do you believe, sir, that the results are going to surprise on the upside, or is there just very little room for that?
So there are certain segments where I think the base for last year was low, right? So for example, last year we saw a lot of the government spending linked sectors in the June 24 and the September 24 quarter, they were kind of on the sluggish side because government decision making was a bit slow. And now we are seeing that government spending has normalized and even accelerated in the last few months. So, the infra, construction, cap goods, the defense, railways pack, we may see some positive results in that. Some of the metals and global commodities, again, they had a lower base last year, and we see some recovery in commodities in certain pockets. So they might see some kind of a positive result. And then we obviously need to see whether there is some traction in some of the other segments like pharmaceuticals, but that will more be of a stock by stock nature. But in general, I would say that there are some pockets of low base which will do well. The big ones that we need to watch for is how the financials do, especially the large banks.
Okay, so before I go to that part of the market, financials, large banks, so is there a pocket that you're seeing where growth will also be quite decent and valuations also don't look all that expensive? Would you have maybe a sector or two which might strike that fine balance?
That will be more stock specific, but I'd say that in some of the retail financing names, whether it's the smaller banks or some of the NBFCs, you might see some positive surprise because the cost of funds has come down, and finance companies or banks which have a relatively higher proportion of fixed rate loans, they might surprise on the positive side. And some of them in the sub pockets have started showing loan growth also. For example, some of the microfinance, gold, etc., those kind of pockets, they have shown decent growth in assets. And if that is coupled with some improvement in margins, then you could see some positive surprise there. Some of the other names where you were seeing margin pressures last year, they might also come back.
So what about unsecured and microfinance? Is the asset quality cycle looking much better now? In your opinion, is the worst well over, and are we now going to see a recovery?
Yes, I would say so. Again, won't cover every bank or NBFC in the same brush, but overall, I would say that the worst is over. A lot of provisions have been made, and the fact that RBI cracked down on some of the growth that we saw in these pockets last year is also going to help. So I think that a lot of cleanup has happened in this segment, and we are seeing volume growth coming back. Ultimately, the for these pockets, if you see volume growth coming back, it means that now the managements are confident about the asset quality. Typically, if the asset quality internally is not looking that great, then they will not go for growth. But if they are going for growth, it means that they are internally satisfied with the asset quality trends.
Sir, you spoke about cap goods as well. Some of the cap goods names have seen some real sharp bounce up from maybe in the last 4-5 years. They've been 5-bagger plus. Where is it that one can strike a fine balance between, again, growth in terms of EPS and cash flow and valuations?
In cap goods, typically we've seen that cash flows is not that much of an issue. It's basically how the order book pans out. That is more the driver. Cash flow becomes a bigger issue in some of the construction names where the government or state governments are big clients. There the receivable cycles tend to be a bit longer. But in general, cap goods has been a good cash flow generating segment, and a lot of the companies in this segment are very well run, and a lot of them are multinationals also. So in general, the ROE, ROC are pretty decent. So it's all about order book, and we have seen that especially in the power segment, the railway segment, some of the other infra segments, we have seen good ordering happening, water segment, etc. There has been good ordering happening. That's what I think is driving some of the recovery and some of the longer term trends.
But again, sir, isn't execution there far more key than ordering? Because ordering activity has been really, really strong. Okay, maybe FY25 was not a very strong year, but otherwise, if I look at it from a 3-year perspective, and therefore, shouldn't the focus shift more towards execution, some of these names? How do you view that?
Execution has not been an issue. I think it's more of the order book.
Sure.
Execution was an issue in some of the defense names, I would say, where there were capacity constraints or plus minus in ordering, some confusion about parts availability, etc. But typically, we've seen that at least the private sector, we've not seen too much of a problem in execution. If order book is there, then execution happens.
Point taken. So how are you seeing real estate as a sector? Again, it's one of those sectors where there's been a multi-year tailwind and it's cyclical as well. do you see this being hit by cyclicality anytime soon, or do you see that this is still going to be a 3-4 year, or rather there's a 3-4 year tailwind to this?
I think we have seen very good traction in real estate. Uh, I would say that given the very strong last couple of years, there might be a breather sort of a thing. But if I look at the next 2 to 3 year view, it's still positive. Having said that, prices have moved up a bit sharply in the last 1 year, 1.5 years especially. So that might cause some kind of a pause in the volume growth in the very high premium segment. But I would say over 2 3 years, I think it should again normalize. In the middle ticket segment, I think the traction is still quite decent as long as the micro market doesn't has not seen too much of a price growth.
Okay. Mihir, while we're at it, I'm also curious to understand what you make of some of the capital market plays, and where is it that you feel there is best value within that entire capital markets basket. There are just now so many ways to play capital markets.
No, absolutely. So, I mean, we've had a decent exposure to capital market segment, but we have reduced a bit in the last few months, mainly because of concerns about valuations and, I would say volumes coming down in some of the segments, etc. So we have booked some profits there, but structural story is very strong. As long as savings continue to grow, as long as we have more and more investors coming into the system, that longer term trend will continue. So I think it's more about relative valuations, tactical switching, but structurally all the segments frankly look good. The less cyclical segments would be, the asset management companies, the distributors, etc., the insurance segment where the cyclicality is lesser. Some of the other capital market links segment like brokerages, etc., they may tend to be a little more cyclical. But I think if you look at 3 to 5 year, all segments will grow quite well, I would say.
Thank you so much, sir, for coming in, speaking with us, giving us all of that perspective. It's always good to get a big voice like you come in and give perspective to investors, to retail investors, at a time when we've seen a bit of a consolidation in markets as well.
Thank you. Always a pleasure.